So thank you, Ishan, for joining the session on the Pillar 2 discussion, which UAE has introduced in 2024 with effect from 2025. So now the concern is how the companies have to be ready, what all they have to do, what is the action plan, how it is going to impact them. So yeah, I just wanted to have a candid discussion on that. So let's say why Pillar 2 was introduced basically across the globe. I'm not talking about UAE. UAE just implemented it, but how the idea came in.
Yeah, so totally agree with you, Girish, that this is just a big hot topic which is ongoing currently in UAE. Not even in UAE, it's across the globe. So, the reasons for that is very simple, I would say. Jurisdictions were it's a end to race to bottom in corporate tax perspective, because jurisdictions were giving tax incentives to lure the investments in their jurisdictions, and which include definitely 0% corporate tax, or maybe investment incentives based on certain investments which will be done,
Free zones,
etc.
Yeah.
Or if you set up a plant and machinery, you get a accelerated depreciation or something like that. So these all incentives which were given to the MNEs were taken advantage of to, how the entities were not having the substance, and they were artificially transferring the profits from a high tax jurisdiction to these jurisdictions so as to optimize the ETR at group level, and therefore at a global level there was a leakage in tax. Of course, not all the companies were doing it, but there were some leakages which were there in the overall system of taxation. And to curb this system and to incentivize the decisions of investments based on the skilled manpower or the availability of resources, and rather than the tax incentives, this sort of a global minimum tax initiative was taken up by OECD and other countries. So just to be briefly, it's that you have to pay minimum 15% tax in whichever jurisdiction you are into. That's the brief about this taxation.
So when companies were trying to optimize the effective tax rate, so then the global, the political world, the global tax authorities, they were thinking of how to create a barrier for that.
Yeah.
And now we have to find a solution for that.
Correct.
So that's what it is going on right now. Okay, fine. But then some discussions are also going that it will be maybe the EU who is, taking this forward at this moment, the Pillar 2 initiative, though it was, there were other global economies also involved. But then there is a talk also going on that they are in the verge of withdrawing, or there's a discussion going on and all, as US has backed out completely. But then they are also thinking how to be a part of it, but without impacting their tax revenues.
Yeah, so as the rules are, formulated, the best case scenario is if everyone joins the Pillar 2, then it will be the best case scenario, because then there will be no tax leakage. But if some of the countries are not there in the system, maybe the entire system will collapse for Pillar 2, or it will not be that optimized, which was intended to be. So as you mentioned, US is the biggest country which is not yet going on for this Pillar 2, and then there are some side approaches that it is taking. There's no still clarity on it. We hope to have the clarity. Again, China is also silent on this. We don't know what China is thinking. Yeah. India is also not keen for this. So again, it's still an uncertain situation, and we hope to have a clarity soon. So that, because now the compliance is already on, so it's not like the regulation is in just draft stage. It's actually implemented by majority of the European countries and Asian countries also. So right. Now there has to be some clarity immediately so that it is beneficial for the entire system.
Correct. So approximately 55 countries have already, drafted the guidelines and everything for this. So backing out of that is out of question at this stage, I would say, because that would seem like a political mistake, which the world don't want to, showcase off. But yeah, definitely they would be taking the corrective actions in the future, how to rectify it.
Yeah.
So now going to the point of, who are the concerned persons in UAE that should be thinking of, okay, Pillar 2 is going to be applicable to us. So yeah, who are the...
So Pillar 2 is applicable to an MNE group. So now it's important to understand what is an MNE group. So just an example, if there is a parent company in UAE and it has a subsidiary again in UAE only, it will be constituted as a group, but it's not an MNE group because it is operating only in UAE. For an MNE group, there has to be one entity which is different from the first entity. So if UAE has a subsidiary in, let's say, Oman, then it will be constituted as a M&A group. So all the constituent entities of an M&A group will be considered as prone to this Pillar 2 regulations. It's important that, see, in this part of the world and in European nations, there is a permanent establishment also concept which is thoroughly utilized by every M&A group. We have branches in various countries. Generally, we consider branches as an extension of the head office only, and we consider it same entity only. But from a Pillar 2 perspective, this permanent establishment or a branch, it is considered as a separate entity. So if you have a branch, if UAE headquarter has a branch in, let's say, Oman, that will be considered again having an entity in two jurisdictions and not just an extension of UAE taxation. So even the permanent establishments are covered in this. And then there are some specific rules for JVs also, that JVs will be considered as a separate group because JV will have a different characterization than a M&A group. But then again, they have been brought into this gamut of Pillar 2. There are some minority holding entities also which will be there. And then there are some exclusions that regarding government entities, non-profit organizations, or some investment-related entities which are excluded from the Pillar 2 regulations. So from an entity perspective, these are the entities which will be there. To summarize, just an M&A group which is operating in multiple jurisdictions is covered under Pillar 2 regulations.
But then, apart from the applicability and the exclusions, there are other conditions also with respect to the revenue part.
Correct.
Now, this is where some of the companies are concerned about, because the word that is used across the Pillar 2 guidelines is consolidated global turnover.
Yeah.
Now, the consolidation is, of course, definitely it should be as per the accounting standards. Basically, most of the countries follow IFRS, and then they have their own accounting standards and all. But with respect to IFRS also, when we are talking about consolidation, is it at the ultimate parent entity level only we have to consider, or any other stages of consolidation do exist? And if that is the case, then how we have to take care of the turnover part? Because the turnover number 750 million euro is what everyone looks into.
Yeah.
So how we will qualify in that part?
Yeah, very valid discussion that is going on. So turnover is considered as a consolidated turnover of the ultimate parent entity. So when I say ultimate parent entity, we have to say that where the consolidation stops. So there should not be any consolidation above that entity. So let's take an example that we have a UAE entity whose regional headquartered entity is in, let's say, Oman, but the ultimate parent entity is in UAE. The UAE entity, in UK. The UAE entity may not be interacting with the UK entity. It will be interacting only with the Oman entity, considering it's the regional headquarters. And Oman may be doing the consolidation part for their perspective, maybe since it's a regional headquarter, or maybe it's required by their law or whatever reason. But then Oman has a holding company in UK. So we have to check the turnover of the UK entity, which will be the ultimate parent. And it is assumed, if we assume that there is no consolidation above UK, then we will stop at UK level. So turnover as per consolidated financial statements of the UK entity are relevant. Again, as you mentioned, it's only applicable where the turnover crosses the threshold of 750 million. So as we discussed some time back, it's not like every entity will be covered in this sort of gamut. 750 million is a very big amount of threshold which is there. So they want to just first of all tax the bigger entities, so that, and maybe their intent is to lower the turnover in maybe future, but for now it's applicable only to the entities whose turnover exceeds 750 million in 2 out of the 4 previous years. So again, this 2 out of the 4 previous year is also relevant to be noted. It's not current year, it's not previous year, it's 2 out of 4 previous years.
Okay, so that means if I'm crossing 750 million this year, but in 2 out of previous 4 years, I have not crossed 750 million, still it is not applicable
Not
to
applicable.
me. Because we have to look, as you said, 2 out of 4 previous years. Now, let's say my turnover is only, in dirham terms, it's only, let's say, 10 million dirhams. But my financials are getting consolidated with a foreign UPE. Still, I can come into the Pillar 2 bracket.
Yeah, you may come into that. Of course, since, as I mentioned, it's the consolidated turnover. So your group will be forming part of this Pillar 2 regulations. Again, there are some de minimis exclusion and safe harbor if you are a small entity, because they don't want to burden the small entities. We'll discuss that in some time. But yes, you will be covered in this Pillar 2 regulations.
So now, with respect to the tax, it's basically about computing tax and paying tax to the government. What kind of tax law what kind of tax setup has UAE implemented in this jurisdiction for them to collect the taxes from the entities, and what is the base, what is the fundamental on that?
Yeah, so UAE has implemented the basic regulation which was prescribed to say that whichever entity is operating in UAE should pay a minimum 15% tax. So last year the corporate tax was implemented where the 9% rate has been prescribed. Now from this year it will be 15%. So whichever entity which is forming part of the M&A group which crosses the threshold of the 750 million revenue will be required to pay 15% tax. That is the basic thing. Important thing is even free zones entities will be covered under this tax. So it's not like free zone will have a different status than a mainland entity. Free zones will now travel from 0% to 15%. So that will be a big change from their perspective, because many companies here are free zone companies which are subsidiaries of the overseas entities. So that is the regulation that UAE has brought up.
Free zone entities basically who can get their financials consolidated with a foreign,
correct,
with a UP in the foreign jurisdiction, and that can fall into this bracket.
Yeah.
So ideally that makes sense, because when it comes to corporate tax, they are getting an incentive. But Pillar 2 is entirely different compliance from the corporate tax perspective with different compliance requirements. So under Pillar 2, even the entities which are getting the tax benefits under corporate tax, they also would be subject to tax.
Yeah, definitely they will be also subject. Of course, maybe in corporate tax they are not paying, but then they will be catched under Pillar 2 regulations.
Okay. But then we are hearing this term called DMTT, IIR and UTPR. Then there is some STTR terms and all. Of course, UAE has implemented the domestic minimum top-up tax guideline, which in short it is known as DMTT. Can you just touch base on that, how that is different from IIR and UTPR?
Yeah, so as I mentioned, UAE has implemented that QDMTT, which is basically, as I mentioned, any entity which is operating in UAE has to pay 15% tax. Now, what happens is that, let's take an example where UAE is the parent entity and there is a subsidiary in another jurisdiction. That jurisdiction is a zero tax jurisdiction. So what global rules have been prescribed by OECD says that if that jurisdiction does not implement any QDMTT, in a way, it is enjoying 0% benefit. So then there should be some system to collect the taxes for that entity. So then comes into picture income inclusion rule, which says that if that jurisdiction is not collecting the tax should be collected by the parent entity. So then, as I mentioned, Pillar 2 is implemented in such a way that taxes will be collected somewhere. If not at that jurisdiction, the parent will collect.
So you're not going to escape anywhere.
Anywhere, correct.
Yeah, okay.
Now again, UAE has not implemented IRR. So in a way, UAE will not collect taxes. Then what is the solution? Then the solution is, let's take an example. They have another subsidiary in Germany, for example. And if Germany has implemented this concept of under-tax profits or under-tax payments rule, it will say that German entity will pay tax to the German government, which are attributable to the subsidiary of UAE in a low-tax jurisdiction. So even if there is one entity in the entire group which is in a jurisdiction where all three Pillar 2 regarding components are implemented, that taxes will be collected. So there's no escape unless and until your entire group is in in jurisdiction where there is no all three components. Then only taxes will not be collected. Else taxes will be collected either in the home jurisdiction, either in the parent jurisdiction, or in other jurisdiction. So that's the structure. That's the beauty of this structure, actually.
Okay, so basically it's like, let's give a scenario where in UAE free zones are given the tax benefits, they are not taxed, and UAE is not implementing the Pillar 2 under an assumption, and that free zone was getting consolidated, the financials of that free zone was getting consolidated in any other foreign jurisdiction where they implemented, let's say, IIR. So they would have collected the tax on that from that entity.
Correct.
So instead of that, UAE itself said, okay, if that is going to happen, then let me implement DMTT. So why the tax revenue has to go out to a foreign country where the entity is operating in UAE? So why should not I collect that,
Yeah.
the minimum tax? So that's how they, came into this. But isn't it like free zones are getting, they were given the, benefit of 0% tax with corporate tax. Again, they are getting the 0% provided additional conditions were put. Now with Pillar 2 coming in, they have nowhere to go. Of course, all the free zone companies are not going to pay that. They have to come into that 750 million bracket. But still, those companies will have to pay tax. Do you expect any kind of relaxations or anything from the UAE tax authority or the ministry to, to compensate for the taxes that they are paying?
So there's no specific discussion there are going on, but various countries see this is a direct tax. So in direct tax you cannot do anything because you have to pay 15%. But in global scenario, many countries are now thinking of giving incentives from an indirect perspective, maybe a relaxation in stamp duty or in the relaxation in investments that will be done. So from that perspective, countries are thinking of giving a benefit. So there will be collection from a direct tax perspective,
Subsidies
but then there
and
will
everything
be,
also they would be considering.
Correct. So
Okay.
that is a thing that is going on around refundable credits which are there. So that is definitely ongoing and it will be coming henceforth.
Okay. So coming back to the point of DMTT, UTPR, IRR, which method has most of the countries implemented? Is it DMTT, IIR, UTPR? How it is?
So DMTT and IIR generally are implemented. See, where the country already has a tax rate of more than 15%, so it won't make sense to again have a DMTT because anyway the ETR will be more than 15%. Of course, if they have some credits etc. which are given which will lower their tax rate ETR to below 15%, they will have to implement QDMTT. So QDMTT and IIR are mostly implemented. UTPR is again under discussion in various countries and also implemented in various countries also. So it will be implemented in many countries, but as of now UTPR is on the back seat and IRR and QDMTT are on front seats.
Okay. Now with respect to the tax computation, now an entity can be is subject to 9% corporate tax. Let's say a mainline company for simple understanding, and that company again is part of that M&E with the coming into the global M&E category subject to Pillar 2 guidelines. So that company would be paying 9% tax here. Do they have to pay additional 15% tax, or are they going to pay straight difference of 15% and the 9%, or is there any other way of computing the tax and then paying to the government?
Yeah, so it's not an additional tax. Definitely we have to pay a differential tax only, but the computation mechanism is a bit lengthy and bit complicated. So it's not the corporate tax base that you have to consider for the differential tax base. The computation starts from the financial statements. So you have to refer the financial statements. Your profit as per financial statements and profit after as per corporate tax may be different because there are some exemptions in corporate tax. There are some disallowances in corporate tax. So let's say you have an income of 100 dirhams in P&L, but you may pay tax only on 90 or you may pay tax on 110 because of the corporate tax specific issues. Again, in Pillar 2, you have a different set of adjustments that are required to be done on that income. So your 100 P&L as per financial statements may become 110 or it may go down to 90. So that is the base which will be there for Pillar 2 calculation. Again, from a taxation perspective, let's say your 100 taxable profit as per UAE corporate tax, you pay 9 dirhams as tax. Now this 9 dirhams is not as it is copy pasted for Pillar 2 regulations. Again, there are some adjustments which are required to be done. So there are so many adjustments in that. It's, to be honest, very difficult to discuss all the things, but in crux, there are various adjustments that you have to do to your income side and to your tax side also. And then you calculate your ETR. So let's say your ETR is 10%. So minimum tax rate is 15%. You have to take the differential 5% on the excess profit. Now again, excess profit is something big concept, I would say. It's not that you have to pay 5% on the entire 100 dirhams. We have to exclude some substance based income exclusion. So we discussed in the start of the discussion that it's not like they are taxing everyone. They are taxing only the profits which are not aligned with the substance of the entity. So whatever excess profit that have been there, only that profits will be taxed here.
So this substance-based income exclusion, Like, what all components are included in that? What all criteria we have to look at? Is there any guidelines specifically mentioned or any standard approach based on the OECD guidelines?
Yeah, so it's a formulary approach. They have said that you have to take payroll cost and you have to take tangible assets. You apply certain percentage on this payroll cost and tangible asset, and then you derive, let's say they have given a 5%. So you have 100 dirhams of payroll cost and let's say 500 dirhams of tangible asset. So 5% of 100 dirhams will translate to 5 and 5% of 500 will translate to 25. So aggregate of these two will be considered, and then you exclude this amount from your income.
Okay.
So let's say you have 100 dirhams as income, you exclude this 30 dirhams and you pay tax, differential 5% tax we discussed on this 70 only.
Okay. So basically they're focusing on the asset and the employee.
Correct.
That's what they are focusing on, whether that benefit they are giving to us.
Correct.
So now when it comes to tax computation, there are certain safe harbors also. There are certain exclusions also when it comes to Pillar Two, tax guidelines. How or what kind of entities are going to get benefited because of the safe harbor guidelines under the Pillar Two implementation?
Yeah. So as I said, this computation is very lengthy and complicated. So the effort is to not burden the smaller entities, and the effort is also to give some leeway in the initial years. So there is a de minimis which is available. So let's say the de minimis says that average revenue of euro 10 million and average income of euro 1 million. If you are having that, or if you are below that threshold, you are excluded from the computation mechanism. So that is one option available.
Throughout the life? For life?
That year.
For that year?
That year, yes.
Okay.
So that is one computation. Then we have transitional safe harbor, CBCR safe harbor, which says that CBCR, this 750 million is aligned to CBCR threshold. So you will be definitely preparing a CBCR file for the group. And in that already some computations are done. So what they say is, if you refer that CBCR and do some computations, again 10 million and 1 million revenue and income, or maybe simplified ETR test and substance-based income exclusion. If you do that based on CBCR, because we already have the computation and we don't have to do the computation again as per CBCR, then you will be again out of the Pillar 2 issue for that specific year. And then there are some simplified calculations also for smaller entities. So again, the effort is not to burden the smaller entities and to give some leeway in the initial years so that people get used to the Pillar 2 compliance and then maybe proceed with them.
So when we are talking about the safe harbor, as you said, there are three parameters. One is revenue and profit. Second is the substance-based part. And the third is what?
Third is simplified ETR.
Simplified ETR that you're talking about. But is it like, again, is it going to be for that year or till any specific period or for life?
It will be applicable to 2028 only.
Okay.
So it has a limit. As I mentioned, they have given leeway for initial years because they want people to get educated.
Okay.
And then there will be a detailed calculation which will be required after this period.
Any hope that the period will get extended?
As of now, we don't know, but not sure.
Okay. Yeah. So now another important thing, or whenever any tax law or anything comes up, people are concerned about, okay, paying tax, what all we have to do. There definitely when it was corporate tax, there were corporate tax returns. Especially when it came to a free zone company, there were free zone assessments to be done on the basis of which can influence the corporate tax liability. So when it comes to Pillar 2, what all actions are required, how the company has to be prepared, how exhaustive it is, and based on the submissions also, what submissions we have to make?
Yeah, so from a compliance perspective, there are two compliance. One is the top-up tax return. As I mentioned, if the constituent entity is UAE, UAE has this 9% rate. So definitely most of the companies will be covered under the differential rate that they have to pay taxes. So there is a top-up tax return that has to be paid. For the first year, it is 18 months from the end of the year. And from second year, it is 15 months from the end of the year. So that is one compliance which is required. Then there is again a global information return, which is again prescribed by OECD, and UAE has also adopted that. There is no specific guidance around this, but that will be also required if they prescribed to have that compliance. Again, the formats of these returns are not yet in public domain. So now we are close to year end. Of course, there is time for the compliance, but still the formats are not yet in public domain. Hopefully, they are aligned to the global formats. But you never know, you will get some surprises in UAE. So that is the compliance which is required. From a way forward perspective, again, assessment is required, like whether we are falling under the category or not. Because if we are excluded from the Pillar 2 gamut, life is easy, I would say. But if we are there, then there is a big task which is there. So assessment has to be done first, and then we have to analyze all the things which are there, de minimis, safe harbor, to for initial years we can just opt out of that. But again, if de minimis, safe harbors are not applicable, we have to run through all the calculations which are there in detail, and that will be an exhaustive thing. Corporate tax, maybe it's possible to do in 1 year, 1 month. Pillar 2 definitely not possible to do in 1 month. So that is one thing, and maybe I would like to hear from you that how they should prepare for this big sort of behemoth which is coming. So,
see, when it comes to collating the data for Pillar 2 submissions, recently there was a session conducted by our institute also, Institute of ICAI Dubai chapter. It was a very wonderful session. In that, very valid point was made that to submit the return itself, to prepare that declaration to the tax authority, paying tax is simple. You have to just, the computation part is the hardest part. To arrive at that itself, a company has to be ready with 250 plus data points. And to get that 250 plus data points, you need to have a robust process or the documentation practice and everything, which it's very difficult for the companies currently at this moment. So a thorough assessment can help them to realize, okay, what they are getting into, if it is applicable for them. To get the data, to collect the data, the company has to be ready with that kind of information. 250 plus data points is not easy, because again, when it comes to e-invoicing, there is a place where the document verification will happen electronically, of course, through the portals and all. But there are 50 data points. That itself, the companies are, trying to understand how they are going to fix that 50 data points in one document. This we are talking about 5 times that, more than 5 times I would say. It's 250 plus data points, yeah. And we are just listing it out, what all data we have to capture. It can drill down to number of employees also, yeah, and jurisdiction wise. So the number of data required is very huge, and the companies cannot escape that. So the entities have to be ready. As a consultant, we can guide, and as a consultant, we can tell them you have to be ready with this kind of data to submit and all. But ultimately, the entities have to restructure their document and data maintaining process as well. Then only in the long run, it will be very smooth for them, or else every year the same hassle will continue. So that's where, a challenge is going to be there. So as you rightly said, 1 month is not enough. It is going to be, a very long process. But fortunately, a considerable time is given. As you said rightly, 18 months from the end for the first submission, 18 months from the end of the first year. That means for 2025, the first submission is going to come in 2027 June. That's the deadline by which we have to submit the Pillar 2 return and the GIR and then pay the taxes. So it's a considerable time, but the companies are already eager to know whether they are going to be applicable or not, and if they are going to be applicable, how much they are going to pay. Because ultimately everything drill down to the cash flow.
Cash flow, yeah.
So now the companies are worried about the cash flow. So yes, it's time to get it assessed and finalize. Just your thought on one final topic. When the companies are collecting the data, or when the companies are maintaining that data, is there any specific way of getting it done, or is there any specific tool for getting it done, or it's like their usual data process, they have to maintain it?
So as you mentioned, 250 plus data points is difficult to collect it manually. There has to be processes, there has to be some support from information systems, because manually anything is prone to errors. So it's better to put in place some tools. Of course, identification of data itself and the identification of sources of that data, because it's not limited to tax. We have to speak to finance people, we have to speak to HR, we have to speak to legal people maybe. So that is going to be a big task initially for the initial years. And once we set up the sources of that data, maybe then information technology can come into place, and then it can be collected, and then the processes can be set up. So that is where the company should think of in long run, because manually this sort of data may not have the solution to everything.
So basically, they have to integrate their finance, legal, IT, HR, every departments, and get the data. Have a centralized approach, or some kind
Yeah.
of a tool has to be used to keep it updated.
Yeah, that
In
will
the long
be
run.
beneficial for them.
Okay. So Ishan, thank you very much for having this information shared, because we wanted our viewers also to have an understanding what they are, going to face when the pillar to compliance comes in. Everyone is comparing that, okay, it is going to be like corporate tax only. A difference is there, 6% we have to pay. Just wanted to give an idea that it is not going to be corporate tax at all. If corporate tax is a lake, this is going to be an ocean.
Yeah.
That's what we want to, that's the best comparison we can give.
Correct.
So thank you for sharing your insights on that, and hope this is helpful for the viewers, and we can start guiding our clients on advising them correctly to get it implemented at correct time.
Yeah.
Thank you
very
very much. Thank you.
Thank you.